straight over to you. Thank you very much.
Great. Thank you so much. So great to see so many of you here today. This is the Search for Income panel on why investment trusts have the answers. Now, I'm Annabel Brodie-Smith. You don't know me. I'm the Communications Director at the Association of Investment Companies. I have been there for 28 years championing the cause of investment trusts. I'm also passionate about financial education, about getting investors involved with investment trusts. I'm also passionate about diversity. When I started out in my career 28 years ago, there weren't so many women that looked like me. So I'm glad that things have moved on from there. Today, I'm hoping what you're going to take away from this is that why investment trusts are just quite so good for income investors. And we're going to look at their specific benefits. Now, I am a great fan of audience participation. So don't think you're just going to be able to sit there. I'm going to ask you a question right now. I also really want to be able to take some of your questions in this panel. We want to get you involved. So my question for you now, and let's think, what percentage of the investment trust industry has a dividend of 4% and above? What percentage of the investment trust industry has a dividend of 4% and above? I've chosen 4%. We've just had an interest rate cut. So interest rates are currently at 4%. Right, I'm going to stand up because I've got absolutely no chance of seeing you anyway. Anyone want to hazard a guess? Go on, any old guess. Anything. 60%. 30. Yes? Okay. Anyone else? 75. 70. It's actually 42%. 42% of the investment trust industry has a dividend of 4% and over. If we were looking at 3%, that would be 52% of the industry having a dividend over 3%. So actually, 42% is quite a high percentage of the industry with a dividend over 4%. And we want to find out why. So I'm really delighted to have my panel, and I have to say I've personally asked them to be involved today, so thank you so much for giving up your time. I have here with me Sue Noffke. She's the manager of Schroder Income Growth and head of UK Equities at Schroders. Now, my panel I've chosen very carefully because Sue invests in UK equities, so she's going to talk to us about equity income investing. And thanks so much for coming, Sue. Then we've also got Rhys Davies, who's the manager of Invesco Bond Income Plus. And I wanted us to have a bond manager. Bond investment trusts are in vogue at the moment, and we want to find out why and more about that. And finally, we have David Bird. He's the manager of Octopus Renewables Infrastructure Trust. In the renewable energy infrastructure sector in the investment trust world. I think it's going to be really interesting to find out, David, the renewable energy sector has had a bit of a tough time. We've seen a little bit of a change in sentiment recently. We're going to discover more about that. So my first question to the panel, and as I say, I would like you to ask you some questions. So do think of some questions. I'm going to ask about 5 questions. Then I'm going to open it up to the audience to see if any of you have any questions. My first question to the panel is, what is the objective of your trust and what is the yield? And I'm going to ask that to Sue, the UK Equity Income Investment Trust Manager.
So the trust I run has 2 objectives. The first is an income one, and that's to grow income and to grow it ahead of inflation. And the second objective is to grow capital. So quite simple, grow income ahead of inflation and to grow capital. The yield currently on the trust is 4.5%.
Thanks very much, Sue. Very succinct. Rhys, same question.
Okay, morning everyone. So Invesco Bond Income Plus is the trust that I manage. Stock market ticker is BIPS. Easier for me to refer to it as BIPS going forward. So BIPS is an income fund. We're aiming for a relatively high level of income. Dividend yield today is around 7.2%. so fairly high, and we are investing in the bond market. So it's pretty simple. Bond income plus, investing in bonds to earn a decent level of income. Not all of the income that we're making today is being paid out as dividends, as some of that is being kept and reinvested. And the idea is that with a bond fund, you've got that certainty of income, or relative certainty of income. It's a contractual obligation. We know what we're going to be earning over the next few years.
Brilliant, Rhys. 7.2, that's pretty impressive, I have to say. Okay, David, what's the objective of your trust and yield?
Yeah, so Octopus Renewables Infrastructure Trust, again, that's a bit of a mouthful, so I'll call it ORIT, which is the ticker. ORIT is looking to deliver a sustainable and growing level of income, as well as an element of capital growth, and doing that through investing in the energy transition, in particular renewable energy generation infrastructure that is going to be sort of the backbone of our economies and of our power demand in the future. So mainly we are developing, building and operating wind and solar generation across the UK and Europe. Those are assets which provide quite predictable, often government-backed income streams, and that allows us to service a dividend. And where the share price is at the moment, the dividend yield is tracking at just a shade under 9%.
That's quite a yield as well. We're going to talk more about that and delve into that. So, Sue, you're a UK equity income sector, so you're a trust investor in UK equities. Please, can you tell us a bit more about your portfolio?
Yeah, so the portfolio, as Annabel said, is predominantly UK equities. I can invest outside of the UK market, but I've chosen to have the vast bulk, so 98% or so is invested in the UK at the moment, because I can see lots of really attractive investment opportunities in our home market as opposed to overseas markets. And the portfolio splits about 75%, about 3/4 in large cap companies, and about 1/4 into mid and small sized companies. And my style of investing is that I don't take, as a portfolio, big skews to either growth, quality, or value. I search across the whole market for opportunities, so a really wide opportunity set, and seek to blend a concentrated portfolio of about 45 individual names into a portfolio that's reasonably style neutral and can deliver on those two aims of attractive income that grows ahead of inflation and delivers capital growth for investors.
Thank you, Sue. Rhys, let's hear about the bonds you invest in.
Okay. So we're investing, or BIPS is investing predominantly in the corporate bond market, so as opposed to government bonds. So many household names that people will be familiar with have issued corporate bonds that we will invest in. So Morrison's, Boots, Centre Parks are all examples of what we would call high yield bond issuers. That is, they are deemed to deem that by the rating agencies. So they're deemed to carry slightly more credit risk. Boots issued a bond recently, a few weeks ago, with a 7.4% coupon, which we thought was relatively attractive to put into the portfolio. Obviously, the high yield part of the market does carry more credit risk, so we offset that, we balance that with a nice slice of investment grade rated bonds. These are deemed to be better credit quality profile, but the quid pro quo is that the yield on those is less. So currently that's about 30% of the portfolio. And then within that, that mix of high yield and investment grade bonds, predominantly, like I say, it led into companies, but also to banks and insurance companies. So we particularly like what are called bank capital bonds or CoCo bonds. They are the junior debt of a bank. For some questionable reason, the FCA does not permit individual investors to buy those bonds. You can buy a 3 times leveraged bank equity ETF, but you can't buy those junior bonds for whatever reason. So what BIPS can do is offer access to those types of instruments within a portfolio. So we'll be investing in bank capital bonds from Lloyds through to a small building society like Newcastle Building Society, which has a bond with a 12.25% coupon per annum. So they're paying us that every year for the portfolio. And that's what I really like about BIPs, is that it can offer investors access to these instruments, which on the whole are not accessible to a lot of investors.
Yeah, very useful for investors to get access to those type of investments. And David, I know you've got a particularly diverse portfolio within the renewable energy sector. Let's hear about it.
Yeah, so we've set ORIT up actually with the view that that diversification is important within any sort of sub-asset class, just as it is in a wider investment portfolio. And we see at the moment there's a lot of political ebb and flow around sort of support for renewables. Actually, in Europe, there is still very broad-based political support for getting more renewables built because they are, in fact, the cheapest form of electricity generation that's available, even with sort of putting storage alongside them to sort of smooth out the ebbs and flows. But we think it's important to be spread out both in technology and geography. So rather than just investing in solar farms or just investing in wind farms, we have a roughly equal split between the two. And if the data going back years shows that in a year which is sunnier than average, it tends to be a little bit less windy, and vice versa. It's definitely not a perfect anti-correlation, but there is some genuine anti-correlation there which smooths out the volatility of returns. And then also, because we're in multiple geographies across Europe, and our mandate also allows us to invest in Australia, although we haven't done to date, if there's a particular country that's providing more attractive incentives to get more renewables built, we can focus our investments there and sort of follow where the best value is for investors. So right now we've got assets in the UK, Ireland, France, Germany, Finland. We've previously invested in Poland, Spain, Sweden. And we are a UK-based investor, so we're somewhere between 40 and 50% of our underlying asset value in the UK right now.
Great. Now, I'm going to go on to talk about discounts and premiums. Investment trusts trade at their share price, buy them on the stock market, really very straightforward. But the discount or premium tells you something about the sentiment towards the trust. So if it's trading at a discount, then the share price is below the asset value. If it's a premium, it's above the asset value. So Sue, can you tell us about the discount, your thoughts on this? And maybe a little bit about sentiment towards the UK. We've heard a lot today already from Simon French, from Lord Lee. They think the UK, there's lots of potential there, and it's just been underrated.
I would agree with all of that, but let's put it into context. So about 12 months ago, we were hitting poor sentiment. Really, the change of government had discovered a black hole. There's another black hole to be filled. And people were nervous about government policy and what that would mean for the domestic economy, the tax takes, the pressure on businesses, and the pressure on individuals. And the way in which sentiment is reflected in the stock market and then into the investment trust sector, our sector of UK investments, and particularly the income sector, came under pressure. And that meant that prices fell well below what would normally be expected in relation to the net asset value. So in other words, the discount widened out, and the discounts became, on average, double-digit into the teens. What happened towards the end of the calendar year 2024 was an activist investor, I'm sure some of you will have heard of Saber Capital, came in to try and exploit some of those discounts, that undervaluation across the sector, and bought a number of positions. That was kind of a wake-up call to the investment trust subsector. And at the same time, what we've seen over the course of 2025 is investors waking up to the benefits of diversification. So rather than having all their eggs in the US equity market, which has delivered fantastic returns, the volatility around about Trump's Liberation Day caused people to reassess. Data that we just published as a house yesterday shows that appetite by US investors for international equities, actually UK equities is at the top of the pile. So with 20 billion new investment into the UK equity market, and that would compare and contrast to outflows from US investors into Europe, which has stolen a lot of the headlines. So something to think about. Headlines can sometimes be misleading. And I think that encapsulates what we're seeing in terms of investor appetite through bids. There's definitely a valuation opportunity. We've seen a lot of bids and even competing bids from private equity and corporates, quite often overseas businesses as well, but some domestics. What we haven't seen yet, which I'd like to have change, is increased appetite by domestic investors for our home market.
Okay, can I just also say, can you just say what the discount is of the trust to you?
So the discount of my trust is currently just under 10%, so 9.5% today. That has narrowed in from a teens discount of about the final quarter of 2024. So discounts have come in a little bit, but they're still giving an attractive opportunity to buy assets at about 10% off sticker.
Thanks, Sue. And I should tell you that the average investment trust discount currently is just above 13%, to put that in some context. Now, Rhys, you are, as I said, these bond investment trusts are in vogue, and yours is one of them. Can you explain, obviously you're sitting on a premium, perhaps you can tell us about that. Perhaps you can explain why sentiment is so strong and whether you expect that to continue.
Yeah, we're in a good place. We've been at a premium for a couple of years now. But over the last decade plus, we've actually traded more often than not at a small premium. So it's currently, it hovers around 1% to 2%. Like you say, the loan and bond sector within the investment trust world is, I think we're pretty much all trading on a small premium. Why? I think a couple of factors. One, income is far more attractive than it was a few years ago. So we went through 2022, went through a major repricing in yields and in bond yields. And so there's just a lot more income available today. And for us, we really saw the tipping point, funnily enough, around October 2022, around the time the mini budget issues in the market. When yields everywhere took another leg up, so gilt yields rose, corporate bond yields rose, and it was as if at that point investors and potential shareholders looking at BIPs and other funds in our sector started to see that there's a decent level of income there, and started to get interested, and that's when we flipped to a premium, and we pretty much stayed there ever since. I think we briefly went to a discount around Liberation Day, but actually that was quickly snapped up and back to a premium. I think what you get, what people understand that you get with bonds and loans within our sector is that certainty of income. So it's a contractual obligation from a company to pay that interest rate, that coupon, every year. And if they don't, then there are consequences for that bond issuer. So it's that certainty of income gives people the confidence, I think, to invest in our market. And also, I mean, it's mark to market every day for the NAV. So the majority of what's in the portfolio is liquid. Bond prices move around every day, but we have live prices. They get reflected to the market every day. So when investors are looking at BIPs, they can invest with a very high level of confidence that the NAV is what it is. It is reflecting what's in the portfolio, and so they tend to pay around NAV or a slight premium for that.
Brilliant. Well, you can see that reliable high income is very attractive for investors, Invesco Bond Income Plus, and it explains its premium. Right, now, David, we've got a different scenario, haven't we, in the renewable energy infrastructure sector, which has gone through a torrid time and is trading at very wide discounts. Perhaps you could explain a bit about why that is, the discount in your trust, and what you think the prospects are.
Yeah, absolutely. So, I mean, there's an element to the story for the renewables and some other sort of alternative income investment trusts that's effectively the inverse of what you've just heard about on bonds. So, a lot of the vehicles in our sector were set up and marketed as alternative sources of income in a world where there just wasn't a high level of income available on bonds. And post 2022 and mini budget, I've heard it from investors, we don't need to invest in a bond proxy now because there's attractive income on bonds. So I don't need a bond proxy. So I think that's been part of it. So discounts have widened in order to give a sort of yield premium over bonds, which are generally lower risk because of the nature of the instrument, depending on what kind of bonds you're investing into. I think another thing that's happened is just a bit of a supply and demand mismatch that's partly linked to that same point. So we've seen a lot of wealth managers selling. We've also seen a lot of wealth managers consolidating and becoming larger and larger and needing larger and larger vehicles to allocate to. And that's made it very hard for them to buy, and generally also sort of outflows from some of the multi-asset managers and institutions that have also been big supporters of the sector. So what that's led to is a sector where everyone's trading on between sort of 20 and 40+% discounts to net asset value. Right now, Orit's just a shade under 30% discount the last time I checked the screen. And that inevitably raises questions around the net asset values, actually. But it's a question I think there's a very clear answer to, because within Octopus, we don't just manage an investment trust. Our investment trust has around £1 billion worth of underlying asset value, sort of gross of gearing. Our team manages over £7 billion worth of assets. That other £6 billion is in private markets funds, where they have been raising capital at well over £1 billion a year. So there is still huge institutional investor appetite for the asset class. Renewables are not out of vogue. They're out of vogue within the investment trust space. And that money we have had to put to work, and we are out there buying assets in the marketplace, bidding on the same assumptions we use to mark our NAVs in the investment trust. And we're in competitive processes where we lose more often than we win. So we're very confident in the underlying net asset values. But there's this sort of dislocation in the market where institutional, big pension funds, big insurers don't want to hold the investment trust because of the sort of daily volatility in the share price. And so are willing to commit and to buy assets at full value, whereas if they bought the investment trust, they could get them at a 25-30% discount. And that really means there's a huge value opportunity there for investors who are willing to hold the shares in the investment trust, because they're the same assets and the net asset values are robust. And therefore, the yields, which would be 6 or 7% on a NAV basis, are high 8s and 9s on a share price basis. So there's plenty to be had.
Yeah, I mean, we have seen, we know the renewable energy sector is popular, and we've actually seen some institutional investors, private equity, whatever, come in and bid for the assets of the investment trust because they think they're a buying opportunity, quite frankly. They're undervalued and they want to hold these quality assets. And we've seen that happen a couple of times recently. Yeah,
it has. It's taken a while to get going. And again, there were lots of questions from investors in sort of 2024 as to why isn't this happening? Does that mean we can't trust the NAVs? And again, now it is happening. We've seen 2 or 3 already. Some more, I think, will come because there is that value there. And again, because the asset class is strong. And that's one of the reasons I'm very sort of positive on the sector. I think it's fair to say that in sort of the period from 2016, 17 through to the middle of 2022, we probably got to a place of just having a bit of an oversupply of vehicles in this subsector. There were sort of 21, 22 names at one point in the sort of renewable energy infrastructure subsector. We don't need that many. There's multiple different trusts doing sort of the same niche within what's already a sort of niche, albeit massive investment sector. So we probably need a bit more of that, a bit more either merger of trusts or take private. We haven't yet seen what we've seen a lot of in real estate and some other sectors where there's been a lot of merger activity over the last year, making bigger trusts that sort of feed the demand from the consolidating wealth managers. That hasn't happened in renewables yet. I'm sure it will.
And that's potentially an investment opportunity again
Absolutely.
for investors sitting here. I mean, there's a lot of corporate activity going on in the investment trust sector. In the first half of the year, we had a combination of 17 acquisitions, liquidations, and mergers. And that is continuing. We had another merger announced yesterday. So potentially that is again, an opportunity for investors.
I certainly think so.
Brilliant. Right. And moving on, what advantages of the investment trust structure do you use when investing for income? And I'm going to ask that to see first.
Yeah, so for me and my trust, the opportunity is very clear around being able to deliver smoothed increases in income to investors over multi-year periods. Schroder Income Growth Fund was launched nearly 30 years ago, and it's got a 29-year track record of always increasing its dividend. And the way in which we've done that through periods of market cycles when income has been scarce, you can think about the global financial crisis, and you can think about the COVID and post-COVID period, is not to distribute the entirety of any annual income generated to investors in that year. We have within the investment trust structure the ability to retain about 15% of annual income in our back pockets to help top up income when it's proved to be a scarce resource, such as the last 3 years or so. And that enables confidence for our investors in the delivery of attractive income and the fact that it's going to grow each year, because you as investors will have costs that grow year on year. So that's what we do.
Thank you, Sue. I mean, Sue is one of our 20 dividend hero investment trusts. These are the investment trusts that have been increasing their dividends consecutively every year for over 20 years. And I know she's very modest, but it's really quite an achievement. David, I'd like to go on to you. Clearly, investment trust, great structure for investing in hard to sell and liquid assets like the ones you invest in.
Yeah, absolutely. So it's almost the other way around for us from what Sue described, where we've got assets that, by their nature, they often have a government support scheme, or we've got our Irish solar farms, for example, have got a 15-year fixed price contract for all the electricity they sell with Microsoft. It's a very sort of high quality counterparty. So we've got very high confidence in the income. A lot of those revenue streams are also contractually inflation linked. So we've been able to grow our dividend in line with inflation for the last 4 years in a row, and at least in line with inflation every year since the trust was launched in late 2019. And so we've got this predictable revenue stream that allows us to provide income and keep growing it. But the asset class is not like a bond or an equity where it itself is relatively liquid. These are real assets. There is an active market for them, but a transaction can take 6 to 12 months to complete. So having the assets in the sort of permanent capital structure of an investment trust is a really neat fit. We're not having to liquidate assets that aren't well suited to liquidating quickly, that you'd have to do in an open-ended structure. And so there's just a natural fit with these long-term real assets and a long-term permanent capital structure of an investment trust.
I mean, it really allows you to take a very long-term view of your portfolio. You are not forced to sell. I mean, obviously, LTAFs were mentioned by Simon French in his introductions. LTAFs, long-term asset funds, a new type of semi-open-ended funds designed to invest in sort of private markets and infrastructure, have not actually been tested through difficult markets. They don't have the track record that investment trusts have. We've got private equity investment trusts investing in unquoted companies going back to the 1970s. It is a great structure for this type of difficult to sell assets. Now, Rhys, what advantages of the structure are you using?
Well, I think the point you just made and David made about being closed-ended, not having to worry about outflows, being able to invest confidently for the long term, that's the the biggest, most important feature of an investment trust that then allows you to take advantage of that feature. So for me, it's kind of threefold in terms of the benefits. One is we can set the dividend target. So for BIPs, it's 12.25 pence per annum per year. We pay that quarterly. So having certainty of the size of the fund and the structure, we can set that dividend target, and then also being invested in bonds, we know what's going to be coming through for the next few years. So we can give that target relatively confidently for the next 2 years. The second is using gearing. So again, being closed-ended, not having to worry about outflows means that we can use some borrowing within the portfolio. I think it's a very powerful tool. It's a very important tool. It's something that has to be used very carefully and prudently. We have a long track record of doing that within the team. So over 2 decades of experience of managing trusts with borrowing through various investment cycles. We think we know how to manage those risks. But really what we'll be doing there is using that gearing to buy more of the bonds that we like and to enhance the income. So it's typically 10 to 15% of the NAV is borrowed again and invested. But we can go higher. And the other really important feature around borrowing, or benefit we get from borrowing, is not only to enhance the income, but it's having liquidity available when we need it if there is a market sell-off. So bond prices move around every day. There's a secondary market for bonds. If you go back to 2022, we had a huge repricing in bond markets, and it was not uncommon to see bonds from good companies trade down 20, 30% in price terms. Again, the great thing about a bond is you know what the end game is. You will get repaid that money so long as you've done your credit work and the company doesn't default. So these are, a good company, very easy to see their bonds fall 20 or 30 points during a major repricing in yields, and you know that if you buy that, you will get that capital back by the maturity date. So having the liquidity available in a sell-off, which we can get through gearing, is really important as well. So we would typically take the gearing up in a period like that. And then the third point, which is kind of coming back to the points already made, is really about having that ability to invest with the actual underlying investments with a long-term view. So really kind of looking through the noise in the markets, being able to buy bonds in a sell-off, and to invest for the long term.
Brilliant, Rhys, that's really great. Gearing, I'm really glad you brought up gearing because nobody's mentioned that yet. Great, let's try and take a few questions if there are any. I can't actually see anything here because it's so dark. There's one there. Thank you so much.
Thanks. All interesting points. I've got someone who mainly invests in investment trusts. I'm very much guilty of diversification, and the sector, the AIC, I think, sort of been tarnished by some of that. I won't name them here, but we all know who I'm talking about in some of the digital spaces, and REITs that have been taken over. I just wondered how you think those relative discounts going from my right to left are widening based on the sort of asset class. So the bonds, I'm a big investor in BIPs. It's done exactly what it says on the tin for me. I'd love to ask if you think that the sort of refinancing challenges are behind you now for the bonds that you currently own and maybe sort of rolling over. That would be for the bond market. The equities fairly understandable of a 10% discount on that sort of good yield, but I feel that the ORIT discount, the size of it, is really a reflection of retail investors like me being absolutely having potentially very little confidence that some of those NAVs are realizable, given some of the sort of boards that have folded in some of that alternative space. So I know that's a complicated, long-winded question to answer, but
it's quite a complicated question to answer that one. Okay, I'm going to kick off with Rhys. Can you address the issues on the bond market?
Yeah, so it was
refinancing.
Bond refinancing. Yeah,
Yeah.
So bonds. So a typical bond that we'll invest in will have a 5 to 7 year maturity at new issue, which means that we're lending to that company for that period of time, and they'll pay us the coupon along the way every year. pre-2022, when yields were generally lower, companies would be issuing at the current yield in the market for whatever was appropriate based on the secondary market for that type of credit risk. So we were seeing the high yield bond market in Europe, for example, trading at an average index yield of below 3.5%. So I think it's 3.4% at the end of 2021. It's come a long way back since then. We touched around 8%. We're back at just below 6% today. So far more interesting for investors. That decline back, going back. So what that means for companies, though, is that they were able to issue bonds and borrow very cheaply for a long time, and then they've had to get used to borrowing in a high yield, high borrowing cost environment. So it's good for us. What we are seeing is yields have come down, so companies are, and the market is very, very strong right now. So there's a lot of demand for yield out there and not enough bond issuance. So we are seeing high yield bonds come in with coupons that are lower and lower than they were a couple of years ago. Nothing like pre-2022, but certainly lower than late 23, 24. And that gives us pause for thought. We have to be thinking very carefully about whether that's enough yield compensation for our understanding of the credit risks of investing in that company's bonds. So we've always got refinancing risk in the bond market. It was certainly in our favor coming out of 2022 because companies that borrowed here were having to borrow again up here. So it was not uncommon to see companies paying twice as much on their coupons when they issued a new bond, and we're very happy to lend to them at that. Going forward, we'll always have this refinancing issue. Bonds are not perpetual. Most of them are not perpetual. They have a limited lifetime. So in a falling yield environment, it makes it a little bit harder to keep the income as it is. But as I've mentioned a couple of times, we've got that visibility, at least in the portfolio, for the next 2 to 3 years. The average maturity left is around 4.5 years. So we can see for the next 2 to 3 years, pretty much we're happy that we can achieve that 12.25 pence dividend target that I mentioned. So it's an ongoing challenge when you're a bond fund manager, is thinking about refinancing.
David, I think we've got to go to this point about concern about the valuations. Presumably this is a sector mainly held by institutions and wealth managers. Would that be correct? Yeah, and some retail investors.
It is. And actually increasingly, if you look at how our registers evolved over the last year or so, we've seen the retail execution-only platforms just coming up and up and up, and the sort of the two biggest, I think, are now 1 and 4 on our register. So there is a lot of retail money seeing the value here, but it's entirely understandable that there are questions on valuations, because there have been some sort of high-profile blow-ups in alternative income. I think if you sort of step back and look at where those have happened, though, it's not been in renewable energy generation. There's definitely been big valuation swings in some of the sort of adjacent areas, particularly battery storage. When you look at the fundamentals of renewable energy generation and the kind of assets we're investing in, there's the valuations ultimately is driven by what are people, what are big institutional investors willing to pay for these assets on the market, and that comes down to the assumptions around what cash flows they're going to generate and the discount rate you apply to those cash flows. So there's a whole range of assumptions in the first bit, and then one big assumption that clearly does move around as underlying rates and just supply and demand and investor appetite evolves. So no one can guarantee that the NAV that we're marking at, if we were to have to sell all of our assets over the next year, would we achieve our NAV? Would we achieve plus or minus 5%? No, there's enough that can move within that there is variability. But for the assets we're holding, I don't see anything that would lead to an outcome where we're at minus 25, minus 30, which is where the shares are trading, because the specific assets that we and a lot of the other renewable trusts as well are holding are in technology that is very well established, with cash flows that are highly fixed price in nature. So we've got about 85% of our revenues fixed price over the next 2 years, over 70% of our revenues fixed price over the next 10 years, more than half of the value in our sort of gross asset value and our net asset value, I think, actually, that's again sort of contractually fixed price. So yes, there are questions around what might the power price be in 2050. And there is variability in how much a wind farm will produce this year and next year, but nothing like the variability that would justify a 25 or 30% discount. I get that for a retail investor in particular, to have to sort of do the homework on that and to be able to compare a vehicle that's got a very high level of fixed revenues with perhaps some of the ones that are winding up at the moment that had much less and had much more exposure to the sort of day-to-day power price in Spain or Norway. But for a lot of the names out there, including Orit, there is more certainty to a lot of those assumptions. But yeah, how to access that sort of research. Again, the institutional buyers have got a wealth of different sell-side analysts you can buy research from. There's less high-quality research out there for retail, I think, and that's probably something. We try to do a lot of presentations to retail, give a lot of access to people to come and ask exactly those sorts of questions. But I think there's more we need to do to give confidence and to allow people to ask about those assumptions, because ultimately that's what drives the value.
I have to say at this stage, of course, there is the AIC's website, theaic.co.uk, which has got extensive data and information on all our member investment trusts. And you will have a specific area for your trust where there'll be a whole host of information. I'm afraid I'm going to have to wrap this up now. We could talk all day, couldn't we? But I hope that we have demonstrated the benefits of investment trust for income investing, the ability, as Sue said, to smooth that income so we've increased our dividends over such a long time period. The ability to that closed-ended structure, that fixed pool of assets, which allows managers to take a long-term view of their portfolio, which both David and Rhys mentioned, and of course, the ability to borrow and invest, gearing, again, something that Rhys mentioned that are very important. I should emphasize that these benefits are not just benefits for income investing, they can also enhance your capital returns. I'd like to thank you for coming along today. I'd particularly like to thank our managers, Sue, David and Rhys. And I've got to say, I'm really hoping to see some of you at the Investment Company Showcase. This is the AIC event, which we're running on the 10th of October. We have 30 investment trust managers presenting and talking at that showcase. It's free to attend. Please do go to the AIC website, theaic.co.uk, to book your ticket, and hopefully see you then. Thank you so much.